What if I told you there are two ETFs paying over 12% annually in monthly dividends, and they're actually growing your money instead of just bleeding it dry? I'm talking about real money here. If you invested $100,000 into either of these funds, you'd be collecting over $1,200 every single month. That's $14,400 a year from one fund alone. But here's the kicker. The IRS isn't immediately taxing these payments like they would with regular dividends. By the end of this video, you'll know exactly which one fits your portfolio and why Wall Street doesn't want you to know about these tax advantages. Stick around because what I'm about to share could completely change how you think about income investing. Let me tell you a story about how two rookie ETFs beat the veterans at their own game. Picture this, January 30th, 2024. While most income investors were settling for measly 3 to 5% yields from traditional dividend ETFs, a new player called QQQI quietly launched into the market. Nobody expected much from this newcomer. Fast forward just 18 months, and this new kid has accumulated nearly $4 billion in assets. That's not just growth, that's a revolution. But QQQI wasn't working alone. It had a wise older sibling that had been paving the way since August 2022, SPYI. Together, these two funds have amassed over $8.7 billion in combined assets, and they're delivering something that seemed impossible just a few years ago. High monthly income with actual growth potential. Here's where the story gets really interesting. In May 2025, QQQI received the Best New Active ETF award. Think about that for a moment. In just over 1 year, this fund went from complete unknown to industry recognition. Meanwhile, skeptics kept saying these yields were too good to be true. But the proof was right there in the monthly payments landing in investors' accounts. The traditional dividend world was being turned upside down. While old-school dividend stocks were cutting payments and struggling with inflation, these two ETFs were consistently delivering double-digit yields month after month. The question wasn't whether they could maintain these payments. The question was how they were doing it so effectively while others were failing. Now let's get into the ultimate showdown between these two titans. In the income championship corner, we have QQQI, the heavy hitter. This fund is currently delivering a massive 14.56% distribution rate. That means for every dollar you invest, you're getting almost 15 cents back in annual distributions paid monthly. We're talking about $6.36 per share in their latest monthly payment. If you own 1,000 shares, that's $636 landing in your account every single month. QQQI achieves this through its tech-heavy Nasdaq 100 strategy. It's basically betting on the continued dominance of technology giants while extracting premium income from option strategies. Your $10,000 investment would generate approximately $1,456 in annual income, paid out monthly like clockwork. In the opposite corner, we have SPYI, the steady champion. This fund offers a 12.05% distribution rate, which might seem lower than QQQI, but don't underestimate it. SPYI's latest monthly payment was $0.5112 per share, and it's built on the rock-solid foundation of the S&P 500. This is the diversified approach. Instead of betting everything on tech, you're spread across all major sectors. Your $10,000 investment here generates $1,205 in annual income. But here's where both funds reveal their secret weapon, the return of capital strategy. This is the tax hack that most investors don't understand. When QQQI sends you that monthly payment, 100% of it is classified as return of capital. SPYI is 98% return of capital. What does this mean for you? The IRS doesn't immediately tax these payments like they would regular dividends. Instead, these payments reduce your cost basis, potentially converting what would be ordinary income into capital gains treatment when you eventually sell. Let me put this in perspective. If you receive $12,000 in traditional dividend payments, you might owe $2,000 or more in taxes depending on your bracket. With return of capital, you owe zero immediate taxes on that same $12,000. The tax bill gets deferred until you sell, and even then, it might be taxed at the lower capital gains rate. Now let's talk performance, because this is where things get really interesting. QQQI has delivered 30.52% total returns since inception and 20.30% over the past year. SPYI has generated 45.91% since inception and 14.55% over the past year. Both funds have significantly outperformed their respective buy-right benchmarks. QQQI beat its benchmark by over 10 percentage points, while SPYI outperformed by nearly 5 percentage points. But here's the catch, and there's always a catch. Both funds sacrifice some upside potential for this income generation. They're not going to capture 100% of a massive market rally because they're writing covered calls against their holdings. It's the classic trade-off in investing. You're exchanging unlimited upside for consistent high income. Now let's pull back the curtain and see exactly how these financial wizards work their magic. This isn't your grandfather's covered call strategy. Most traditional covered call funds write at-the-money calls, which caps all upside potential. QQI and SPYI use out-of-the-money call spreads, typically writing calls 3.5 to 4% above current market prices. Here's how it works in simple terms. Imagine you own a stock trading at $100. Instead of writing a covered call at $100 and giving up all upside, you write calls at $103.50 or $104, means you keep all the gains up to that strike price. Plus, you collect the option premium. QQI typically covers 75 to 90% of its portfolio this way, leaving 10 to 25% completely uncovered to participate fully in market upside. The active management component is crucial here. These aren't passive strategies running on autopilot. The fund managers actively adjust coverage based on market volatility. During high volatility periods, they can maintain income levels while writing calls on less of the portfolio, preserving more upside participation. It's like having a professional options trader managing your covered call strategy 24/7. Let's examine what you're actually buying when you invest in these funds. QQQI's personality is all about tech concentration. The top 3 holdings tell the whole story. NVIDIA at 9.97%, Microsoft at 8.70%, and Apple at 7.81%. The top 10 holdings make up over 51% of the fund. This is essentially a bet on the continued dominance of mega-cap technology companies. The sector breakdown shows about 60% in pure technology, with another 19% in consumer discretionary. Think Tesla, Amazon, Netflix. SPYI takes the balanced approach. Yes, NVIDIA is still the top holding at 8.1%, but the concentration is much lower. The top 10 holdings only represent 38% of the fund. You get exposure to financials, healthcare, industrials, consumer staples. It's the full spectrum of American business. This diversification comes with lower volatility, but also potentially lower growth. Both strategies have merit, but they serve different investor personalities. QQQI is for the investor who believes technology will continue to outperform and is willing to accept higher volatility for higher potential returns. SPYI is for the investor who wants broad market exposure with enhanced income. The risk management in both funds is sophisticated. They're not just hoping the market goes up, they're actively protecting capital through their option strategies. The out-of-the-money call writing provides a buffer against small market declines while still allowing significant upside participation. During the market volatility we saw in early 2025, both funds maintained their distribution targets while adjusting their strategies accordingly. So, who should choose QQQI? If you have the risk tolerance for technology concentration and believe in the long-term dominance of companies like NVIDIA, Microsoft, and Apple, QQQI offers maximum income generation potential. You're essentially betting that these tech giants will continue to grow while extracting premium income from that growth. This fund makes sense for younger investors who can handle volatility and want to maximize their income in today's market environment. Let me give you a real example. Imagine you're a 35-year-old professional who's been building wealth but wants to start generating meaningful income. You have 20 to 30 years until retirement, so you can handle the volatility that comes with tech concentration. QQQI's 14.56% yield combined with the Nasdaq 100's historical growth trajectory could be a powerful wealth-building combination. SPYI is the choice for investors who prioritize diversification and want a more conservative approach to income generation. If you're closer to or in retirement, or if you simply sleep better at night knowing your investments are spread across all sectors of the economy, SPYI delivers solid income with broader market exposure. The 12.05% yield is still excellent by historical standards, and you get the stability that comes with S&P 500 diversification. Here's a retirement scenario. You're 60 years old with a $500,000 portfolio. You need income, but can't afford major losses. SPYI's $60,250 annual income with broad diversification might be exactly what you need. The monthly payments of about $5,020 could cover a significant portion of your living expenses while keeping you invested in equities for inflation protection. There's also the hybrid approach to consider. Many sophisticated investors don't choose between these funds. They use both. You might allocate 40% to SPYI for stability and 25% to QQQI for growth and maximum income, with the remaining 35% in other investments. This gives you diversification across strategies while maximizing your overall income generation. You could also dollar-cost average into both funds over time. Start with whichever fund matches your risk profile, then gradually add the other as you become more comfortable with the strategy. The monthly distributions from your initial investment can even fund additional purchases. But let's talk about the red flags, because I'm not here to sell you anything. I'm here to educate you. These yields are not guaranteed. If market volatility drops significantly, option premiums decrease and distributions could be reduced. Both funds are sensitive to interest rate changes. Rising rates can hurt their underlying equity holdings. In a major market crash, these funds will decline along with the broader market, though their option strategies provide some downside buffer. The tax advantages I mentioned could change if Congress decides to modify how return of capital is treated. While unlikely in the near term, tax laws do change over time. You also need to understand that these high distributions are coming partially from return of capital, which means you're getting some of your own money back. It's not all pure income generation. Here's the bottom line. Both QQQI and SPYI represent a revolution in income investing. They're delivering yields that seemed impossible just a few years ago while maintaining growth potential through sophisticated option strategies. The tax advantages make them even more attractive for income-focused investors. QQQI is your choice if you want maximum income and believe in technology's continued dominance. The 14.56% yield with Nasdaq 100 growth potential is compelling, but you need to be comfortable with concentration risk. SPYI is your choice if you want solid income with broad market diversification. The 12.05% yield with S&P 500 stability offers a more conservative path to the same goal. The key insight here is that both funds represent the future of income investing. They're not just paying dividends, they're actively managing sophisticated strategies to generate consistent income while preserving capital and growth potential. This is boring but brilliant investing at its finest. I want to know, which ETF matches your risk profile? Are you Team QQQI with maximum income and tech concentration, or Team SPYI with diversified stability? Drop a comment below and let me know your thoughts. If you found this analysis helpful, smash that subscribe button because I'll be tracking both funds' performance monthly and sharing updates with my subscribers. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.